Welcome back to the Deep Dive. We're here again, sifting through that mountain of market data to pull out the insights you really need.
That's the plan.
Today, we're really putting on our technicians' hats. It's a full technical analysis deep dive.
Right.
Our goal is a rapid but, thorough look at the technical performance of some key sector ETFs and related instruments.
All right.
We're using the closing data for the week ending October 24th, 2025.
Yeah, and we've got this incredibly detailed report here full of AI-generated technical signals. It's quite something. This isn't about news or fundamentals today. We're looking straight at the market mechanics, the momentum, volatility, where the money's actually flowing, and that constant push and pull between buyers and sellers.
Now, this is really your shortcut, right? To grasp that underlying conviction, or maybe lack thereof, just by looking at these core technical indicators, volume ratios, moving averages, all that good stuff.
Exactly. We're cutting through the noise.
We have a ton of raw data price, volume, where things stand relative to those big moving averages, the 200-day and 200-hour, plus detailed buyer-seller power metrics, gap analysis.
It's a lot to unpack.
It is. So let's see what the AI is telling us about the market's pulse right now. Where's the money really moving?
Okay, so first things first. To get a feel for the overall market, you got to start with the big dogs, right? SPY, QQQ, DIA.
The heavyweights. S&P 500, NASDAQ 100, the Dow. They set the stage.
They really do.
Yeah.
And looking at the numbers for these, honestly, it tells a story that, well, it makes you cautious, even with all the trading activity.
Let's start with SDY. The S&P 500 ETF. It closed the week at, what, $677.25?
Yep, $677.25.
Yeah.
And the daily volume, nearly 74.4 million shares.
Wow. That is massive engagement. Institutions aren't just sitting around.
No, they're definitely active. But, and this is the interesting part, the technical signals around that volume are kind of contradictory.
How so?
Well, look at its implied volatility rank, the IV rank. It's low, just 17% and trending down.
Okay, 17% down. For listeners, maybe just quickly, what does that IV rank signal?
Sure. It basically tells you how nervous the options market is about future price moves compared to the past year. So a low number like 17%, that suggests complacency. The market's pricing in, very small, predictable moves ahead.
Complacency, that calm before the storm feeling sometimes.
It can be. But here's the puzzle. If the market's so calm, according to IV rank, why is the price action, well, struggling?
Good question.
And that leads us to the power dynamics. This is key. Across SPY, QQQ, and DIA, we're consistently seeing strong seller DN and buyer DN readings.
Okay, let's break that down. Seller DN, buyer DN. What exactly are we looking at there?
Think of it like tug of war, but momentum is crucial. Seller DN means sellers are currently winning. They're pulling the price down.
Right.
But the DN part means the momentum is decreasing. They're getting tired. They're still winning, but maybe running out of steam a bit.
Okay, so they're dominant but fading. What about buyer DN?
Buyers are there. But the DN means their efforts, their accumulation. It's weakening, too. They aren't really fighting back strongly. They're kind of holding ground, maybe, but not taking charge.
So the net result is?
The net result is what the report calls M-trend, or medium trend. It's being dictated by that downward pressure because even though sellers are tiring, the buyers are just, well, too weak or maybe unwilling to step up decisively.
A tired downward drift.
Exactly. And that pattern holds for all three main index ETFs.
Right, QQQ, the tech index is very similar. Closed at $617.10. Huge volume, too, 47.6 million shares. 4B ranks slightly higher, 22% downward.
So pretty low, though.
Yeah, still low. And the same power dynamic. Seller DN, buyer DN, M-trend. It's really unified across the board.
It is. And DIA, the Dow tracker, shows even less short-term volatility, just 15% IV rank downward. Volume's much smaller there, 7.2 million shares, but the pattern is the same.
So the big takeaway from these heavyweights.
High volume, low anxiety according to the options market, but dominated by this fading downward price pressure. It screams choppy consolidation, the market's struggling for conviction, and the immediate momentum bias is still, well, pointing lower for the indices.
Okay, so if the indices are relatively calm, in terms of implied volatility at least, where is the real action? Where's the risk concentrated?
Yeah.
We need to look at the IV rank extremes across the list.
And the extremes are really extreme. It tells you capital is hyper-focused, top of the list, KOLD.
The leveraged natural gas ETF, always volatile.
Always. But this week, a staggering 94% IV rank. trending downward.
94%. That's basically off the chart.
It's practically a panic signal, yeah.
Yeah.
It means the options market is bracing for potentially massive moves in natural gas futures. Huge directional risk, total uncertainty, could go anywhere, explosively.
You don't see 94% normal markets. That's something fundamental happening there.
Absolutely. And then on the other side, where volatility is actually building, we see ZBRA. Zebra Technologies.
ZBRA, okay.
53% IV rank, which is high, but crucially, it's trending upward. That suggests rising anxiety, bigger expected price swings potentially coming for that specific stock.
Interesting. And conversely, the quietest spots, where is IV rank lowest?
No surprise here, it's the safety plays. Bond ETFs.
Predictable.
Totally. TFI, a muni bond ETF, is almost asleep at 5% IV rank upward. SHM, another muni fund, even lower, 3% downward.
So what does that tell us overall?
It reinforces the picture. The real perceived risk, the expected big moves, it's all concentrated in things like commodity speculation like KLD and maybe some specific growth names like ZBRA. Meanwhile, stable debt is priced for extreme calm. It's a very, very selective market right now.
All right, let's talk volume, not just the total shares, but the ratios. Comparing current volume to past periods, this is where you spot that institutional excitement, right? Or maybe rotation.
Exactly. Volume is conviction, but the change in volume, the ratio, tells you about shifts in that conviction. It can highlight catalytic events hidden in the daily noise.
So looking at the daily volume ratios today versus yesterday, what jumps out?
Frenzy. Absolute frenzy in a few spots. Remember, 100% is normal, just same volume as yesterday. We found one symbol, which, yeah, it's KOLD again, tied to that 94% IV rank.
Of course it is.
It traded 1,515% of the previous day's volume.
1,500%.
Right.
Over 15 times the normal daily volume.
15 times.
Okay, what drives that? Is it massive short squeeze, a huge institutional rebalance, news hitting the natural gas market?
It's got to be something major. That's beyond just increased interest. It's a market event. Whether it's shorts capitulating in a panic or giant funds making an aggressive bet based on some breaking news, 15 times the volume means a flood of capital hit that asset. A major, immediate repricing was happening.
And were there others? Maybe not 1,500%, but still significant.
Oh, yeah. We saw other big spikes, too, like 252% and 183% for different instruments. Still signals major capital rotation, big interest, but yeah, KOLD is just in a league of its own this week.
For you listening, that 1,515% is a massive flashing light. Something fundamental changed right then, regardless of where the price eventually settled.
Precisely. And then you have the opposite end, extreme low engagement. Daily ratios down at 41%, 44%.
So for those, the market just lost interest for the day.
Yeah, attention shifted elsewhere. Signals consolidation, maybe a lack of immediate news or catalyst, often leads to tighter trading ranges until volume picks back up.
Okay, that's the daily picture. Let's zoom out. Weekly volume momentum. Last week's total volume versus the week before. Does this show more sustained shifts?
This is crucial for confirming if that daily excitement was just a blip or part of a bigger trend. And yes, we see sustained conviction here too. Two symbols stand out with explosive weekly ratios. One hit 656% of the prior week's volume.
656% over a whole week.
Yeah, and that's related to that massive daily spike we just talked about with KLD. It confirms the high trading wasn't just a one-day wonder. It suggests serious, sustained market conviction poured into that instrument over the entire week. Institutions moving with force.
Establishing a position based on a strong view. What was the other big weekly ratio?
Another one came in at 164%, still very significant, showing a definite surge in weekly participation compared to the week before.
And on the flip side, where did weekly volume just dry up?
We saw some really low figures there, too. Weekly participation down at 20%, 30%, 34% of the prior week.
Wow, so interest just evaporated.
Completely. Suggests whatever drove interest the week before is gone, can leave those assets vulnerable, drifting, or susceptible to sharp moves when volume eventually does return. You can't really trust the price stability when participation drops that low.
All right, one more piece in this section. Daily true value. This metric tells us how stretched an instrument's price is, right? How far it deviates from its calculated baseline for that day, spotting potential bubbles or discounts.
Yeah, this is a really interesting application of the technicals, like stretching a rubber band, how far is it from snapping back? We saw some huge extremes on the overvalued side.
How extreme?
One instrument was showing a shocking 38% overvalue based on the daily time frame. Another was at 35% overvalue.
38% overvalued. What kind of price action leads to that kind of reading?
It implies a price spike that was so fast, so sharp, likely driven by one of those massive volume surges we discussed,
Right.
that the underlying technical calculation of true value just couldn't keep up. It's either a bubble forming incredibly quickly or maybe a massive repricing due to some huge external news. Either way, extreme risk or reward potential there.
And the mirror image, the undervalued ones.
These signal potential opportunity or maybe continued risk, depending on your outlook. We saw one stand out at 28% undervalue.
28% below its calculated daily value.
Yeah, and another less extreme one at 9% undervalue. It means these instruments sold off so hard, so fast, that they're trading way below their calculated daily equilibrium.
So for you, the learner, that 28% undervalue, that's not just noise.
Not at all. It's a potential flag for mean reversion. If you think the selling was overdone and the trend might stabilize or turn, that's where you might look. It suggests the sellers really pushed it too far too fast.
Okay, let's get to the bedrock of trend analysis. Moving averages. Specifically, the big one, the 200-day moving average. The ultimate long-term health check.
Absolutely critical, the 200-day. Above it, long-term structure is generally bullish. Below it, that signals long-term structural weakness. And what's really striking in this week's report, looking at this list of sector ETFs,
Yes.
the strong majority are still above their 200-day moving average.
Okay, so on the surface, that sounds pretty good. The broader structure for most of these sectors hasn't totally collapsed.
It's somewhat reassuring, yes. But as always, the exceptions are often the most important part of the story.
Who are the exceptions? Which ones broke down below that critical line?
This is where it gets concerning. The instruments trading below the 200-day MA include the anchors of the entire market. We're talking SPY, QQQ.
Wait, SPY and QQQ are below the 200-day.
Below. Along with EWZ, the Brazil ETF, and XLF, the Financial Select Sector ETF.
Okay, SPY and QQQ breaking the 200-day. That's not just a minor dip. That feels like a major structural signal. We should probably emphasize the significance of that.
It's arguably the most concerning signal in this whole report. When the two biggest market ETFs, the ones tracking the S&P 500 and NASDAQ 100, fall below that long-term support line, it means the recent selling pressure has effectively wiped out months, maybe even a year, of gains on a structural basis.
It confirms the dominant trend isn't just choppy anymore for them.
It's structurally bearish until they can decisively reclaim that level. It's a profound shift in long-term confidence for the broad market leaders.
And it's compounded by seeing financials, XLF, and a key emerging market, EWZ, down there with them.
That combination really paints a picture of broad skepticism about growth, doesn't it? Financials drive the domestic economy. Emerging markets often signal global growth appetite. Seeing them structurally weak alongside SPY and QQQ suggests institutions are shifting to a more defensive posture.
All right, let's shift gears slightly to the shorter term. The 200-hour moving average. This gives us a sense of velocity over the last, couple of weeks?
Exactly. It gauges more immediate momentum. And this is where you often find what we call trend conflict.
Trend conflict, meaning?
It's fascinating. It happens when an instrument is technically strong long-term. So above the 200-day MA, but it's recently slipped below the 200-hour MA, showing short-term weakness.
Ah, okay. So strong foundation, but hitting a rough patch recently. Do we see examples of that?
We did. Key examples include XLP, the Consumer Staples ETF, XAR, which is aerospace and defense, and a few others fell into this above-below category.
So that pattern suggests maybe a pullback within a larger uptrend?
That's often how it's interpreted, yeah. For traders, it can look like a potential buying opportunity, assuming that long-term 200-day support holds. It suggests a healthy consolidation, maybe shaking out some weak hands rather than a full structural breakdown.
A pause for breath before potentially moving higher again? Requires careful watching, though.
Definitely. You need to assess why that short-term selling happened.
Okay, let's wrap this section with the overall trend rating from the report: H trend for high trend, M trend for medium, N trend for no trend. What did we see there?
Well, we already established the major indices were M trend, that medium choppy trend, but we actually saw quite a few symbols flagged as H trend, meaning high trend momentum. These are the ones showing persistent, reliable trends.
And where were those H trends concentrated?
Heavily in defensive, yield-oriented areas. Things like HYMB, which is high-yield munis, TFI, another municipal bond fund, RWR for REITs, XHS in healthcare services, and XLV, the broader healthcare sector ETF.
So the most consistent, reliable upward trends seem to be clustered in those safety trade sectors, assets that tend to do better when uncertainty is high.
That seems to be the pattern, yes. Consistent technical strength focus there.
Okay, let's just pause and unpack this for a second. We've seen a real split picture, haven't we? Most sectors holding above their long-term 200-day average, but the big market anchors SPY and QQQ have broken down below it. We've seen insane volume spikes, like that 1,515% in KOLD, pointing to extreme focus and areas where volatility is really high. Now, if you're finding these insights, which are derived from this really detailed AI-powered analysis of last week's performance, helpful.
Yeah, hope you are.
Make sure you hit that follow button, turn on the notifications. That way you'll be the first to get our full market analysis breakdown each week. We go deep into this data, and you really don't want to miss the next piece of the puzzle.
All right, now we get to maybe the biggest contradiction in this week's data.
Oh, what's that?
It's the difference between how the day started versus how things played out, especially given what we saw with the indices. If SPY and QQQ are showing Celandine dynamics below the 200-day, you'd expect maybe weakness at the open, right?
Logically, yes. Maybe opening flat or down.
But that's not what the gap analysis shows. This looks at the opening price compared to the previous day's close. And the data here is, frankly, shocking.
How so?
Despite all that selling pressure we discussed, nearly every single instrument on this list, something like 28 out of 31, opened the trading session with a definitive gap up.
Wow. 28 out of 31 gapped up.
Gapped up. That implies aggressive buying interest coming in right at the bell or even before in pre-market, driven by overnight news, maybe institutional orders stacking up. It suggests that even though sellers might have controlled the close, buyers were incredibly eager to get in at the start of the next day.
That points to some persistent, underlying positive sentiment, doesn't it? Regardless of the intraday selling.
It really does. It's a fundamental conflict. Buyers enthusiastic overnight, sellers maybe taking over during the day.
So are institutions using the overnight or pre-market to build positions only to potentially distribute or take profits once the main session is underway?
That's one interpretation. It certainly creates a potential whipsaw environment. You get that initial pop, then maybe fading.
Were there any exceptions? Any that didn't gap up?
A few opened in range, meaning basically flat, no aggressive gap. Those included names like XLP, Consumer Staples, XLU Utilities, interestingly XBI and IBB, the biotechs, and XHS Healthcare Services.
Mostly defensive or specific sectors there. Less pre-market excitement.
Exactly. More balanced opening sentiment for those, maybe less volatility expected right at the open.
Okay, so let's drill down into the buyer-seller power shifts again.
Yeah.
But look at the daily versus the weekly power. Who's winning the day-to-day skirmishes and who's actually gaining conviction over the full week?
This detail is crucial for spotting real accumulation or distribution patterns, and we see some really interesting contrarian signals.
Like what?
Well, take ZBRA again, the one with rising volatility. Its daily power was seller day.
Okay, sellers won the day, but their momentum slowed.
Right. But its weekly power was seller up.
Whoa. So sellers won the day with fading power, but over the whole week, their selling pressure actually accelerated.
Exactly. That's a structurally challenging signal. The weekly trend to the downside is gaining force, even if they paused a bit on one particular day.
Any other examples of that conflict?
How about TRI? It showed buyer up daily power. So buyers had a strong day, their momentum increased.
Okay, positive sign for the day.
But its weekly power was Celandine.
So one strong buying day wasn't enough to overcome the overall weekly picture, where sellers were still dominant, even if their momentum was slowing over the 5 days.
Precisely. It highlights that tug of war. Now, conversely, the most reliable sign of healthy buying is consistent strength, right? Buyer up on both daily and weekly timeframes.
Did we see that anywhere? Consistent buying pressure.
We did, and guess where? Back to those defensive and yield plays, XLU Utilities, HYMB Unices, RWR REITs, and XHS Healthcare Services.
Same names again.
Same names. Consistent buyer-up momentum day-to-day and week-over-week. That signals strong, persistent institutional demand. Buyers are stepping in consistently, pushing momentum higher. That's a healthy uptrend signal.
And the flip side. Consistent weakness. Seller DN on both daily and weekly.
Unfortunately, yes. Our market anchors again, SPY, QQQ, and XLF financials, all showing seller DN on both timeframes.
That confirms it then. The short and medium-term pressure remains firmly pointed down for the biggest market players and a key economic sector. Highlights the depth of the challenge.
It really does. Consistent weakness there is a major headwind.
Okay, let's use all these tools, the MAs, volume, power dynamics, gaps, and apply them to a couple of crucial growth sectors. technology and biotech. Their health is so important for overall market direction.
Absolutely vital sectors. Let's start with tech. XLK is the big one, the Technology Select Sector SPDR. Trades massive volume, 7.1 million shares daily.
But how are its technicals looking?
Weak, honestly. Its IV rank is 25% downward, so relatively low anxiety, but it's got that same persistent seller denier Bayerdian dynamic we saw in QQQ. It's classified as M-trend, medium trend, but it's clearly fighting significant downward pressure, just mirroring the struggle of the broader tech index.
What about within tech, like semiconductors, XSD, the STDR S&P Semiconductor ETF?
Right, XSD. High price instrument, $345.28. Its IV rank is a bit higher, 41% downward, suggesting a bit more nervousness there compared to XLK, but still contracting.
And the power dynamic.
Same story, seller deny and buyer dean. The selling pressure and the lack of aggressive buying seem pretty widespread across the main parts of the tech sector right now.
Now here's where those volume numbers become really revealing, talking about where the focus is. XLK trades, what, 7.1 million shares a day?
Yeah, huge liquidity.
Compare that to some of the niche tech ETFs on our list, XZW, XNTK, QUS. Their daily volumes are tiny. We're talking low thousands, 14.3K down to 12.7K shares a day.
That difference is enormous, and it's a critical insight for you listening.
What does it mean practically?
It confirms that institutional money, the big players, and just general market attention, it's heavily concentrated in the established, liquid, large-cap tech fund XLK. The smaller, more specialized tech ETFs. They're suffering from extreme illiquidity right now.
So trying to trade those smaller ones could be risky.
Very risky. Any decent-sized order, buy or sell, in those ETFs like XSW or XNTK could cause an immediate, exaggerated price move simply because there aren't many shares changing hands. Significant liquidity risk. It looks like capital is flying to quality and, importantly, size within the tech sector.
Okay, good point. Let's shift to biotech. We have two main ETFs here, XBI and IBB. How do they compare technically?
Let's look at XBI first. Higher volume of the two, 5.6 million shares. IV rank is 29% downward, again, relatively low. But its buyer-seller power dynamic is really interesting.
Oh, I know so.
It's showing buyer-dean daily power.
Okay, buyers were present, but fading during the day. Price likely dipped.
Right, but its weekly power is buyer up.
Ah, that pattern again. Buyer dean daily, buyer up weekly.
It's often seen as the calling card of quiet institutional accumulation.
Explain that again.
Okay, the buyer deemed daily means, yeah, the price might have softened intraday and buyers weren't chasing it higher aggressively. But the buyer up weekly tells you that over the full 5 days, the intensity of buying actually increased. They're using the intraday weakness to accumulate shares without causing big daily price spikes. Buying the dips, essentially.
Accumulating under the radar. What about IBB, the iShares Biotech ETF?
Lower volume, 1.7 million shares. Slightly lower IV rank at 23% downward, but guess what?
Same pattern.
Exactly the same pattern. Buyer down daily, buyer up weekly.
So that suggests it's not just an XBI thing, but maybe a broader trend in the biotech space. Quiet accumulation happening despite the market headwind.
It certainly looks that way. A consistent structural accumulation pattern seems to be resisting the general downward pull from the indices in biotech. It's a divergence worth watching.
Definitely. Okay, before we wrap up, we have to revisit our extreme outlier one last time. KOLD.
Yes, KOU. The star of the volatility and volume show this week.
Back to the 94% IV rank, the 1,515% daily volume spike. This thing is just defined by chaos right now.
Total chaos. And its buyer-seller power reflects that perfectly. It showed seller up daily.
Okay, sellers gained momentum aggressively during the day.
But buyer down weekly.
So aggressive selling intraday, but over the week, the buying momentum was actually waning against that selling pressure.
Exactly. It confirms massive, unpredictable, two-way volatility, likely driven purely by events in the underlying natural gas market. For anyone watching that space, the technicals are screaming high risk, high reward, and basically saying that external factors are completely overwhelming any kind of normal technical structure right now. Handle with extreme care. Hashtag tag outro.
Wow. Okay, that was a deep dive indeed. We've covered a ton of ground looking at the technical landscape through the lens of this AI-powered analysis for the week ending October 24th. Let's try to synthesize this. What's the big picture takeaway? The so what from all these sometimes conflicting numbers?
The synthesis, I think, is that the market is really caught in a major battle of conviction right now. On one hand, these AI indicators show this persistent underlying desire for things to move higher, You see it in the overwhelming number of gap ups at the open, and the fact that most sectors are still holding above that critical 200-day moving average. There's a baseline bullishness there.
Right.
But that underlying hope is being seriously tested, hammered, really, by active structural selling pressure, especially where it matters most in the core market indices, SPY and QQQ, and key sectors like financials, XLF. These have broken their long-term trend lines. That's a major structural negative weighing things down.
So we're seeing safety sectors like utilities and healthcare showing consistent strength, maybe quiet accumulation in biotech.
Yeah.
But the market's engines, the big indices, are flashing red structural warnings.
Yeah, that sums it up well. And the extreme volume ratios, like that 1,500% spike, and the crazy valuation stretches, like 38% overvalue, they confirm that capital is being incredibly selective, pouring massive conviction into very specific, often volatile assets like KOLD, while maybe ignoring smaller, less liquid plays. Liquidity concerns seem paramount.
So it's a market defined by volatility, selectivity, and this core conflict.
Exactly. Which means you absolutely have to pay attention to those shorter-term signals, like the 200-hour moving average, to spot immediate trend shifts within this larger, very tense standoff.
We really did cover a huge amount of detail today. Trend, buyer power, volume ratios, gap dynamics, critical moving averages. Yeah. If you found this level of detailed market analysis useful and you want it delivered straight to you every week,
definitely give us a follow.
Yeah, make sure to hit that follow button, turn on your notifications. That way you won't miss our next update.
And maybe a final thought to chew on for the week, something to watch for in the next set of data. Given those widespread gap ups, that really aggressive buying right at the open happening day after day, even while the major indices like SQY and QQQ are under consistent selling pressure during the main trading session, what are we actually seeing?
Good question.
Is it institutions using the pre-market to build positions only to turn around and sell or distribute those gains into the strength during the day? Or is this just a messy, classic consolidation pattern, building energy before a more decisive break, maybe higher, maybe lower?
That would tell the difference.
The data forces us to watch those weekly volume ratios very, very closely next week. That might give us the clue we need to see if the buyers with their overnight enthusiasm or the sellers with their daytime pressure are truly starting to establish longer-term control. It's a fascinating puzzle right now.